Hello. Good evening, everybody. Our dignitaries have just arrived. So just give us 5 minutes. They are just coming over. Thank you for your patience.
Sometimes we're not ourselves. There's no one I can turn to. And I know all the feelings that we shared out in the past. And I know your relationships are never meant to last. And I'll take some time, but I'll be alright. We're moving on. We're moving on. I know times are
I thought mic is not necessary. I can address each one of you over here. Probably this is the 15th year in which Garware Club is organizing this budget talk. Today we are very happy that Jain Chartered Accountants Federation has joined with us, and welcome to all the members over here. We have very eminent personalities over here. Like every year we have none other than ANOOP bhai. ANOOP bhai, now. If you remember, every year he gives his talk on budget. Not only that, last time he spoke on the will, which was very successful. So thank you very much for your patronage. So this is what it is, right? So I will request our senior most director, Kadakia Sahib, to present flowers to ANOOP bhai. Kadakia Sahib is the senior most our member in the Garware Club. This is live streaming, so it is live. So this is best thing what we have done. BHAWANA Ben is on the way, so we'll wait for that. We have another very important personality which we have been very lucky that RASESH is here. Kindly come here, please. We must thank Biren. Just Bata bhai. Biren bhai. He has been instrumental in getting Biren bhai. Biren bhai, thank you very much. So I will request another Nitin bhai to present flowers to RASESH bhai. Sir, he's from Balasinor. Sir, from this audience, there are many people who are from Balasinor, and they have told me, sir, that hamara manas hai, very good. Second important thing, sir, you'll be very happy to know, Biren received a call that, sir, you may not join. You are such an important and big personality that you will not come. Biren said, once done, means done. Sir, we are really thankful to you for coming, sir. Thank you, sir. BHAWANA Ben will be
personality, ANOOP bhai. ANOOP bhai actually requires no introduction among the fraternity of chartered accountants, but since some of you are not knowing him, I will just briefly introduce ANOOP bhai. ANOOP bhai is not only a chartered accountant, but he is also a doctorate. He also holds the law degree from the Bombay University, and while passing the CA examination, he was an all India rank holder at the intermediate as well as the INC exam. So you can imagine he has more than 2 decades of experience in tax planning and also corporate laws and also estate planning. He has authored more than 4 books. He has delivered more than 200 talks on various seminars and also awarded the Outstanding Research Contribution Award by the Bombay University earlier this year. We also welcome BHAWANA. Thank you so much. He is also the independent director in various listed companies and also the member of the editorial board of Bombay Chartered Accountants Society. Friends, with these few words, I request all of you to welcome ANOOP back to the round of applause.
Thank you, Shadul. On behalf of Garware Club and Jain Chartered Accountants Federation, President Sahab,
are going to give a moment to Anoop bhai का moment कर दीजिए. Thank you very much, Anoop bhai. This is our procedure that we give it in advance. Now, RASESH bhai, I will request Director Sir to introduce. Can you give a big round of applause for
Good evening, everyone. RASESH bhai is such a gentleman from our community that everyone is proud of. Now, I welcome everyone of you here on this budget presentation, budget discussion, and now I have been given and entrusted with the responsibility of introducing RASESH bhai. Now, as such, RASESH bhai does not need any introduction, being a chairman of Edelweiss, which is a very famous company. As I have been given, I will just go through few my final points. Mr. RASESH SHAH, he is the chairman of Edelweiss Group and has 3 decades of diverse experience in the financial market and has been instrumental in building Edelweiss into one of the India's leading diversified financial service organizations. RASESH bhai also passionate about financial service and the role he plays in translating India into vast saving, into investment. A regular commentator on macroeconomic policies, and RASESH bhai has served as a president of WICI, which is an All India Apex Council, which is representing basically government of India. And in 1780, he has also been a part of high-level task force of Public Credit Registry of India, the Insolvency Law Committee, and Executive Committee of the National Stock Exchange, as well as the committee to review insider trading regulation set up by SEBI. He is probably on lot of committee. I don't have to go through each and every one. Now, going for his qualification, he is an MBA from Indian Institute of Management and Law, which I think when we probably are of the same age, and at those times, IIM Ahmedabad and IIM Calcutta had lot of weight in India. Now there are lot of IIM in India, but those days, these are the two which was holding lot of weight. And he also holds a diploma in international trade from Indian Institute of Foreign Trade, New Delhi. Friends, we welcome him and we all will enjoy listening to him. Thank you.
On behalf of all of you, moment is being presented by our directors, Mr. Naresh Sanju and Mr. Shinji. Thank you very much. Thank you. And now we are very fortunate to have BHAWANA over here. She is also a member, but one of the brightest person in whole of the India for indirect taxation. You have been kind enough to come in the Garware club every year to speak on indirect tax. BHAWANA, we are really thankful to you. And I will request another junior most member from Garware club to introduce BHAWANA.
Good evening everyone and welcome to the panel discussion on the Union Budget of 2023-24. We're joined by three distinguished panelists, and just like the rest of them, Bhavana DOSHI also does not need any introduction. However, I'll try to keep a short introduction on Bhavana DOSHI. Mrs. Bhavana DOSHI is the founder of PPA LLP, an advisory firm, and is a partner of KPMG member firm in India. With specialization in taxation and corporate restructuring, she has been providing financial advisory services to the national and multinational entities in India for over 50 years. She is a chartered accountant by profession from India and holds a master's degree in commerce from the University of Mumbai. She was elected to the council of the ICAI for 4 terms. As everyone is aware, ICAI is the chief regulatory body for chartered accountants in India, and she has also chaired various committees like the Accounting Standards Board, Research Vision 2021, and various other committees of the ICAI. She was also the member of a group supporting tax administration reform commission chaired by Dr. Parsati Shome. She has served as a member of the Government Accounting Standards Advisory Board set up by the Comptroller and Auditor General of India, which is the Chief Auditor of the Government of India. She was a member of the Compliance Committee of International Federation of Accountants headquartered in the New York. Bhavana DOSHI was the president of the Indian Merchants Chamber and is actively associated with its activities. She, during her presidentship, established the IMC Inclusive Innovation Awards to recognize the work of the grassroots level innovators, which meet its criteria of affordable excellence. She is also a regular faculty at various programs of various professional institutes, business chambers, and delivers lectures on topics. Women and child empowerment are very close to her heart, and she takes special time out of her schedule for social activities revolving around the topic. And she has extensively traveled within and outside India. With that, I would like to invite our
I will request Priya Bhai to come here and Pankaj Bhai to offer flowers on behalf of the Garware Club. Priya Bhai, Dekan Bhai, yes, Pankaj Bhai, thank you. कुबीलाल जी, आप इधर आइए। कौन है? एक मोमेंट तो देना है। कुबीलाल जी, we are presenting moment on behalf of everyone here. कुबीलाल जी, Rohit Bhai, our director.
I have with me my young colleague, so preparing the next generation, Aarti Agarwal. Today she will be also joining. Yes, please.
Aarti Agarwal, we are on behalf of everyone. I am presenting
She's speaking at seminars and conferences, and so you are here for the first time. You are.
May I request all the speakers to come on the dais?
Friends, before I invite DILIP and go on the dais, Umesh Bhai, please come forward, and other committee members to present a moment to DILIP, please. He is the moderator for today's program and the background. All other committee members, please.
We are going to start with first direct taxes. That first will hear ANOOP. Thereafter we are going to have indirect taxes by BHAWANA, and the third and last, batsman. We have reserved this for till tomorrow morning. So we have taken his permission, was out of Bombay. He has come specially to address us. And I think there is a lot of interesting things which are happening in last 2-3 days also. So such a great insight into what is happening and what we should be looking for. That is most important. Rashesh Bhai has agreed, but it has to be kept absolutely confidential in these 4 words. I hope, sir, Rashesh Bhai, we will keep it in 4 words.
Just telling BHAWANA that India, if you want everybody's attention, there are 4 areas which are there. You know, cricket, Bollywood, politics, and stock market.
So, with these words,
And that is why stock market has to be last. To retain all of you.
Earlier it was reverse. First was SH and he was after me, he will speak first. I said no, he will be speaking last because there are a lot of queries from each one. I must have received not less than 50 calls. We kindly request SH to give us more time. So we have reserved this call till tomorrow morning. And somebody was asking whether rooms are there. Rooms are there for everyone. So we request.
So good evening, ladies and gentlemen and fellow members at Garware. It's always a privilege to be talking to you year after year. So one question which people have been asking since yesterday, how is the budget? So my answer is, who's asking the question? If you are a common man to HNI, I think it's good. If you are an under HNI, I don't think it's good. And we'll see why. And the Honorable Finance Minister yesterday gave us a very varied budget because she started with Amrit Kal, went on to Saptarishi, went on to Kalyugs. So I also feel that you must look at, just as she said there are Saptarishi to guide, I think there are Sapta Astras against the under HNIs. And I'd like to look at those Sapta Astras in a little bit of detail. So what I would like to focus on in the half an hour which I have is looking at it from an individual perspective rather than going into business and other sort of things, because that's what is the common denominator which touches all of us. So let's first start with something on which there was a lot of news today. That's the tax rate system. Now, if you would recall, in 2020, just before COVID hit our shores, there was a fundamental change which came out. We always used to have tax rates. They came out with a new tax rate system under 115 BAC, and that gave us 6 tax rates moving on in 2.5 lakh slabs, and which said if you opt for this new tax rate system, you cannot take any deductions under ATC, you cannot take any other deductions under ATG, you cannot have household allowance exemption. All of that was gone away, and you were put up in this new tax rate system, which was optional. So if you wanted it, you opted for it, otherwise you continued as is best. Not a big success, and most people did not opt for it. So looking at that and being driven by the fact that they want to cut down on exemptions, they came out with a new tax system yesterday. So now we have the new tax system and we have the old system. The old new is now varied from 1st April. So if I were to compare the old which we have, there are 3 slabs which we all are, or most of us may be familiar with, starting at 2.5 lakh, 5%, 20%, 30%. And then you have the surcharges which go all the way up to 37%. So somebody earning over 5 crores of rupees would be paying a hefty 42.74% of tax. So now, what is the new tax system which came in yesterday, and which is now the default tax system? So now, there's a switch. This becomes your de facto option. If you want to go back to the old, you have to opt out. So this moves in slabs of 3 lakhs. So now the basic exemption is 3 lakhs as opposed to 2.5 lakh. Then you have 6, 9, 12 and 15. And the tax rates move up from nil, 5, 10, 15, 20 and 30%. Important, if you want to go for this, no deductions under ATC, under ATG, no house rent allowance, no interest on self-occupied property, no deduction for foreign loans, no deduction for Mediclaim, no deduction for insurance premium, no deduction for electric vehicle purchase, no deduction for interest on affordable housing. All the 80 deductions, section 80 deductions are done away with, and you have this new system of taxation. Another important and very crucial change is that if you are opting for the new system, then the surcharge is capped at 25%. So if you are earning more than 5 crores, currently the surcharge is 37%, taking your tax rate to 42.74. Now, if you go for this method, the surcharge is capped at 25%, taking your tax rate only to 39%. I'm saying only, but it's in comparison to 42.74. Now, that means if I'm, and I'm not, but if I was a person earning 5 crores, I would save 19 lakhs of tax return. If I was one of those earning 10 crores, I would save 38 lakhs of tax return. So that's a fundamental change which is taking place. Remember, this is only if you opt for the new system. If you want to go back to the old, highest tax remains 42.74%. Should you go for it or should you not go for it? That's been the question. Now, that depends again on who's asking the question. If your income is 7 lakhs, then you don't pay any tax under the new system, so it's a no-brainer, go for it. If your income is 9 lakhs, then a back of the envelope calculation shows that break-even occurs at a deduction level of 2.37 lakhs. So if your aggregate deductions are 2,37,000, you are even Stevens between old and new, it doesn't matter. But if your aggregate deductions go up beyond 2.37, to go back to the old system, you will be better off. If you are in a gross income level of 10 lakhs, then the break-even takes place at 2,62,000. So if your deductions are at 262, no change. If your deductions are more than 262, now you would say, how can my deductions go to 2,60,000? So 1,50,000 is APC. You get 25 to 50,000 of Mediclaim and health checkup and such sort of things. Many people are buying electric vehicles, so you get the electric vehicle deduction. And if you were to make any donation to PM CARES funds, to Swachh Bharat fund, all of that would give you an ATG deduction. So if your deduction levels are 2,62,000, then the 10 lakh bracket, better off going in for the old system. If you are in 15 lakhs, then your break-even takes place only at 3,75,000. So only if your deductions are 3,75,000 or more, should you go back to the old system, otherwise the new system is better off for you. And if you, as I mentioned, if you were the ultra HNI owning 5 crores, no brainer, go for the new system, forego the 1.5 lakh deduction, because it's anyway peanuts or even worse than peanuts for the person earning 5 crores. However, if he intends to make a huge donation in any year, then he may need to revisit whether ATG should be more beneficial. So if you are making a donation or a deduction of 46 lakhs and above, then the old system is better for somebody earning 5 crores or more. Otherwise, definitely better going for the new system. And remember that there are no donations, no deductions. Coming next to something in the business income taxation, although I mentioned it's not relevant, but I would like to touch upon the presumptive taxation which came in. There is a presumptive taxation scheme for two types of individuals, professionals, including HUFs and partnership firms, not LLPs, earning gross receipts of 75 lakhs or lower. So if you are earning 75 lakhs or lower, 50% is treated as your total income and 50% is treated as your total expenses. No books of accounts to be maintained, no audit to be done. Bad news for several of my chartered accountant friends here. But this is an ease of doing business that you just take 50% flat and that's your income and you pay tax on it. If you are in the business, like an MSME, a micro, small, medium enterprise, then the threshold for presumptive taxation has now been increased from 2 crores to 3 crores, and 8% of your gross receipts is treated as your total income. Don't need to maintain any books, don't need to get any audit done. In both of these, there is a caveat. The cash receipts from your business should not exceed 5%. And cash means the official cash which you are showing. Don't go on saying that I have more cash than, otherwise there will be a totally different, then you will have to contact DILIP for all those. So, cash receipts should not exceed 5% of your gross turnover, and only then can you opt for the presumptive basis of taxation. Coming now to the capital gains taxation. Your SEBI has introduced something similar to what we have in DEMAT of shares. Now, as you would now all be aware, DEMAT is physical shares being converted into electronic receipts. Similarly, now we have e-gold receipts. So you have gold, that is physical bullion, being converted by a vault into EGR, electronic gold receipts, which can be traded on the floor of BSE and NSE. And they can be as small as 1 gram, and therefore it gives the benefit of holding over grammage of gold without the problems of physical gold, no problems of purity, etc., because the vault has already done the testing. Now, when you go to the vault and give your physical gold, a question which always arose is it taxable? Of course, it is not taxable, but to lay matters beyond an iota of a doubt, they have provided that when you convert your physical gold into EGR, there would not be any capital gains, it would be treated as a tax neutral transfer. Similarly, if you want to reconvert or rematerialize your EGR into physical gold, you may want your gold back. There would be no tax at that point of time. And the period of holding of the EGR would include the physical gold period. So if I've been holding gold for 20 years and I now convert it into electronic receipts, my period of holding will be 20 years after I hold the receipts for. Same way, when I convert the EGR back into physical gold, it will include the EGR period and the physical gold period. And my cost of the EGR would be the cost of the physical gold and vice versa. So very good amendment. One thing which they have not provided, which they have in the case of DEMAT of shares, is how do you, see what happens is once it becomes EGR, gold becomes fungible. You don't know which is what. So how do you determine the cost? So in section 45(2)(a), they have provided it will be determined on a FIFO basis in case of DEMAT of shares. A similar provision is missing in the case of EGRs also, that it would be determined on a FIFO basis. So whatever came in first will be treated as what is being sold when you sell the EGRs, and therefore the cost and period would be on that basis. I think that would be an amendment which may come in when the Finance Act is passed. Coming now to the SAPTA Astras, and we look at one by one how you will be impacted. The past few years have seen an excellent period for the stock markets, especially in the startup space. There have been a lot of big transactions which have taken place. People have sold shares and made huge capital gains. Now, one of the ways of saving capital gains is to buying a house. You invest the sale consideration in buying a house, and you can save the entire capital gains. Or if you sold your house and you want to buy a new house, it's called investing the capital gains, and you get rollover benefits and you can save your capital gains. So both of these were very popular, and there were several luxury houses which were being sold entirely by virtue of these stock market deals or the startup space or all of that. They now look at this that these sections were meant to promote housing, whereas this is looking at luxury housing. So now they have put a cap that the house value deduction which you will get will be capped at 10 crores. So even if you were to buy a house of 30 crores, which is not unheard of in the city of Mumbai, your deductions will be only with respect to 10 crores. The balance 20 crores will not be treated as your deduction. So look at an example that somebody made a long-term capital gains of 14 crores and he invests 17 crores in buying a new house. Today, that is till 31st March 23, since my gain was 14 and I invested the entire sale consideration, assuming that is the sale consideration also in buying a 17 crore house, I don't pay any capital gains tax because my cost is more than my sale consideration. Now, my cost will only be 10 on although I'm physically paying 17, it will be treated as if my cost is 20. So I will get a pro rata deduction. So now my capital gains deduction is only 9.33 crores. So from 14 crores, I'll only get a deduction of 9.33 crores. And therefore, I will have a taxable capital gains of 4.67 crores. At the tax rate of 22%, I end up paying 1.11 crores tax. So while I am complying with the conditions in full, because of this artificial cap, I end up paying long-term capital gains tax. Big dampener to the luxury market in the real estate, and which was hiding because of this. So you will see a lot of purchases taking place prior to 31st March, and there you will see a big dip. Bad news for many of the real estate companies which operate in the luxury real estate space. You may also see a lot of co-ownership taking place, where 2 or more people from the same family will now buy houses such that each is below 10 crores. But this is something which I think many people do it in a very partial manner, thinking that if I just become a joint owner, that's enough. Transfer of Property Act has different rules for becoming a joint owner. You would need to structure the transaction properly to ensure that you are both treated as co-owners, not just a name owner. You are treated as a co-owner and you are both eligible to get benefits. Second problem which they have is currently you get interest on house property. So if you borrow, if you borrow to buy a house, construct a house, or renovate a house, you would get an interest deduction against self-occupied property while computing your house property income under Section 24. When you go to sell the same house, can you claim that interest deduction as a cost of acquisition? Madras Tribunal in Ramanuja's case has taken a view, yes, you can do that. So this leads to a double deduction. You claim interest first under house property, and then you claim the very same interest while computing the capital gains from the sale of the same house. This is something which the Income Tax Act now seeks to plug. So they are looking at saying that from 1st April 23, you will not get this double deduction while computing capital gains if you have already claimed a deduction under any other provision. That is, if you have shown it as a deduction from your house property income in the past, you will not get that amount of deduction while computing your capital gains from sale of this house property. So this is something which is another negative which needs to be looked at. One of the biggest negatives from an ultra HNI perspective is the taxation of market linked debentures. Now this is something which was waiting to happen, but it's quite harsh. Now what are market linked debentures? And for the benefit of all of us, hybrid debentures listed on the stock market where your principal is generally protected, issued by NBFCs on a large scale, and interest is variable. It is linked to some stock market index like the Nifty CNX 500 or something of that sort, and if that index is met, you get the interest, otherwise you don't get. So if there's a payout which is linked to an index or some market event, that's why it's called market linked debentures. Now what used to happen in these debentures, which were in the vicinity of 9 to 10%, and Rashesh Bhai would throw more lights on the practical side of it, but I'm looking at the taxation angle, is that just prior to redemption, they would be bought back. And therefore, you do not get the interest, you get it as a long-term capital gains because they are held for more than 12 months, and therefore listed securities held for more than 10 months would be, more than 12 months would be treated as long-term. And there would be a 10% capital gains plus surcharge, roughly 11% on the redemption proceeds. So if I'm getting 10% on the secured MLT minus 11%, 8.9% is the return which I'm getting. Compare that with your bank FD, way better. Compare that with your debt mutual funds, much better. Compare that with any other secured debenture, much better, because your tax rate is only 11%. So this tax arbitrage was a favorite amongst the ultra HNIs, and therefore you saw a lot of money being diverted from banks to this. To ensure a level playing field and to do away with this tax arbitrage, what is being sought to be done is that now the entire gain component would always be treated as short-term capital gains. So even though it's a listed security, even though I'm owning it for 12 months because the MLT period is generally 18 to 22 months, it would yet be treated as short-term. And Once in short term, it gets taxed as per the slab rate. You lose out on the entire long-term capital gains benefit. So now instead of 11%, my tax could be 35%, it could be 39%, it could be 42.74%. So now my 10% minus 42.74%, it's a killer to the instrument. What is bad is that this applies to all MLDs, even those which were issued earlier. In the case of insurance policies, and we see that in some time, they have said only those insurance policies issued after 1st April 23 will be covered by the harsh provisions. This applies to all MLDs. So if I had invested at 10% last month thinking that I'm going to pay only 11%, now it's 42 or 39 or 35, it takes away my entire rationale for investing in this instrument. So something which I hope that they kind of change it. Although I wish, but I know they will not. That's how I put it. Another change, currently debentures which are listed and in dematerialized format. Interest on that, there is no TDS. So this was one of the attractive selling points of listed debentures. That you don't have to deduct any tax at source and you just pay interest. You pay tax on your interest on advance tax and other cases. And if you are a senior citizen with no business income, you don't even pay advance tax. So the entire tax was back-ended to your self-assessment tax, which was very attractive. They say that this is leading to a lot of evasion. I don't understand how. When you have an annual information statement issued by the debenture issuer, how is it leading to evasion? I don't know. But they have now brought back the TDS on debentures at 10%. So now even if it is listed and demat, there would be a 10% TDS on the interest. So dampener for the savings sector. High value insurance policy attack. Now currently, single premium or large premium insurance policies, life insurance especially, are very popular. People pay a huge premium and they claim the proceeds as exempt, and therefore it's very attractive. Again, they want to curb this. So they've come out with a new provision. From 1st April 23, only for those policies issued on or after 1st April 23. See, here they were very clear, it does not apply to those. So if you have a policy issued today, you will get the benefits as per today's law. This is only prospective from 1st April. If there is a life insurance policy where you paid a premium of 5 lakhs or more in any of the financial years, then you will not get the exemption which you receive on maturity. However, if it is received on death, maturity benefits, the tax benefits continue. And how would it be taxed? It would be taxed as income from other sources in the year in which you receive the proceeds, less the premiums, if any, which you have paid. However, if the premiums have been claimed as a deduction, say under 80C, then you will not get any deduction. Now, I believe there is some unfairness in this also, that it will be taxed as income from other sources. Why should it not be taxed as capital gains? Is not an insurance policy, once you are saying it's an instrument of saving, it becomes a capital asset. You should tax me as a long-term capital gains, let me pay 20%. Okay, you may do away with indexation, but at least put it in 20%. Why should I pay 35? Why should I pay 39? Why should I pay 42? So I think this is an unfairness which is again writ in this. As they say, devil is in the detail. I would say Asur here is in the detail because we are looking at a Vedic budget, so I am going to use only Vedic terminology. Next is REITs and InvITs, real estate investment trusts and infrastructure trusts. Now what are these, to give you a little bit of a background? REITs and InvITs are trusts which are set up like a mutual fund which invest in a special purpose vehicle which are owning a rented real estate property. So you have Embassy REITs, you have Brookfield REITs, you have Raheja REITs, which are the three listed REITs which we have in the country. And on the other hand, you have infrastructure trusts which invest in infrastructure projects. Like Sterlite has a power infrastructure, you have IRB which has a road infrastructure in it. So these are some of the new age instruments which are there, and they issue units which are listed on BSE and NSE. You can buy and sell in them. How does the trust make money? So the special purpose vehicle will declare dividend, will declare interest, and in case of a real estate company, it will pay rent to the trust. The The trust in turn is treated as a pass-through entity. So it does not pay any tax. Everything goes to the unit holder, and the unit holder pays tax on the dividend, on the interest, on the rent. So there is a single point taxation from SPV to the unit holder. Trust is done away with. Now what is also happening is that the trust has funded these SPVs by way of pushing down debt on it. And many of these SPVs are repaying the debt to the trust. The trust in turn is repaying it to the unit holders. Unit holder says, this is not rent, this is not dividend, this is not interest, I am not paying tax on it. REIT says, I have a pass-through status, I am not paying tax on it. So what the income tax department is saying, all of you are not paying tax on this repayment of debt. Now I will tax you, that is the unit holder, if this is not rent, not dividend, not interest. That is any other form of income distribution, I will tax it in your hands as income from other sources. And if it is redemption of the units, I will tax it in your hands after subtracting the cost of the unit again as income from other sources. Why not as capital gains? Because a unit is clearly a capital asset. Why should I pay tax as income from other sources? So if you see throughout the budget, there is a theme to tax everything which should have been capital gains as income from other sources. And I am pushing you from the 22% bracket directly to the 35 to the 42% bracket. Again, one of the unfairness which is writ large in this. A unit is clearly, you may yet argue that an insurance policy is not a capital asset. A unit is nothing but a capital asset. There is a TDS now on winnings from online games, so Dream 11, Fantasy League, NPL, online poker, online rummy, very popular. So now it was only a matter of time before which we'd end up paying 30% flat tax on it and TDS on it, which is something which is expected because if you look at the horse races and the betting and the gambling, it has the same taxation system. So why should it not be for online sector? If I were to pin the single most problematic provision, it would be the tax collected at source on LRS and foreign travel. So let's look at a background. Currently, Indians have remitted $19.6 billion in 21-22 under the liberalized remittance scheme. So you can remit $250,000 $250,000 every year after year per person. And this is gone for buying property, it is gone for travel, it is gone for education, medical, etc. Currently, in 2020, they introduced a 5% TCS. That is, the authorized dealer through whom you send this money will collect tax at source at 5% on whatever you are sending. And if you are paying to a tour operator, say a Thomas Cook or an SOTC, taking a package to one of these foreign countries, then he will collect 5%. The authorized dealer collects only if the aggregate remittance is 7 lakhs or more. The tour operator collects at every rupee. And this even applies to travel agents because this applies for hotel booking, ticket booking, everything. So there was a shift to go into the online foreign portal market. If I book through booking.com, I don't pay any tax. If I book on swissholidays.com, there's no TCS. But if I go through the Indian travel agent, I have this TCS. And these guys were as this dead because of COVID. Now they have gone and killed them totally. So there has been no case for revival. So what they did is they've come out with 20% TCS. What was 5% now becomes 20%. And look at it like this. This is a family of 4 opting for an 18-night holiday to the US. Thomas Cook charges you currently 21 lakhs for that. 21 lakhs will now entail 4.36 lakh TCS. Now normally it's the father who pays for it, so he will end up having a TCS of 4.36. Indians generally travel in April, May when vacation season is on. So that means at the beginning of the year you end up paying 4.36 lakhs. So it is advance tax in advance. And this will be set off against your ultimate tax liability. So don't forget to set it off while computing your income. Otherwise you'll realize at the end you'll have a nice refund check paid, pending for you. So department is getting money in advance because of this TCS. What is the logic? Some of the bureaucrats have said that people have bought houses abroad and they are not disclosing income. So by 5% they will not disclose income, but by 20% they will get all this information. I would be happy to understand how that happens. But if you see today's Times of India in the front page, this is an article which says that it would definitely now push Indians to buy hotel bookings and other things through foreign hotels. So this would be one of the things which would now be more relevant. And if you are an Indian using your credit card abroad, then the LRS limits do not apply to you. So if you go abroad, just lock your room here and go abroad and pay for it abroad. Go abroad and book the sightseeing abroad. You do not have this TCS. So that's another thing to bear in mind. Whatever you incur on your credit card while abroad, FEMA regulations do not apply, do not treat it as LRS, and therefore TCS also will not apply. Very common for a family of 4 to buy a house abroad by remitting $1 million. Family of 4 come together, all of them are co-owners. Now they would have to cough up an astronomical 1.64 crores as TCS for buying that house. So that becomes an additional cost to be borne in mind. LRS is also possible from minors' bank account. So parents and guardians will now have to ensure that the minors also pay TCS on that. And if you are planning to send any money abroad, plan and do it before 31st March. If you are planning to go abroad on holiday, plan and do it in March, or at least pay for it in March. Otherwise, you will end up paying that additional 20%. Lastly, some other changes. Currently, you have the section 56, which taxes gifts made by a person to another person. Of course, there is a host of exemptions, like gifts made on the occasion of marriage, there is no tax. Gifts received from defined relatives, there is no tax. Gifts received on deathbed, there is no tax. There is certain category of non-residents or residents who are these Trishanku type people who are neither non-resident nor resident. They are at both places, which we know in income tax terminology as a resident, not ordinary resident. And here you have 3 types of people, prominent amongst them being Dubai and Saudi Arabia residents who have income more than 15 lakhs in India. They would be treated as RNOR because they don't pay any tax in their country. Or if you are residing abroad and you have income more than 15 lakhs in India and you stay in India for 120 days or more as opposed to 182 days, you would become an RNOR. Now, if a resident makes any gift to such a person, that gift will now be taxed in the hands of that non-resident or that resident, not ordinary resident in India. But it is only for gift of money. The section applies to money, property, shares, art, jewelry, bullion, etc. This section for non-residents and for resident not ordinary is only for gift of money. However, as I mentioned, gifts on occasion of marriage, deathbed, relatives, no tax. So brother making to another brother who is a resident not ordinary, no tax. Cousin making to cousin, tax. Nephew making to uncle, no tax. Uncle making to nephew, tax, because an uncle is not a relative, but a nephew is a relative. Now, why this absurdity? I didn't make the law, I only interpreted. So, these friends are the 7 major problems which I see from an ultra HNI perspective. And besides this, it's otherwise a good budget. So, if I were to say it's good, depending on who's asking. So thank you very much. We have questions at the end.
Thank you, Anoopa. We have Mr. Manish Shetwera, our treasurer, who has come. There was a death in his family, his brother died, but it is nice of you to come. May I request Manish Bhai to present flowers. Thank you very much for coming. Normally he never attends any function, but today he has come. So thank you. Thank you. Although Anup Bhai has said any questions are there, now we are permitting only 5 questions. Any questions? Yeah, one by one. Yeah, that gentleman. 5 questions only. Now you must remember that after 5 questions, each question will be charged 1 lakh rupees per question, which will be credited to the Garware Club also. Yes, sir. Yes, sir. Your name please?
It's a nice talk, first of all. My question relates to MLDs, and Rasesh sir also could add to that. So would even the equity MLDs that were unlisted be taxed at 20% now also be taxed at your slab rates?
Yes.
Nothing that will be considered out there regarding
Unless the industry makes a strong representation.
This is a big loss for us as well as RASESH as well. And also regarding insurance policy, so the paragraph 5 in one of the annexures reads that 5 lakhs in a year. So this does not apply retrospectively and does not apply to multiple premium checks as well.
It does. It does. It's even if aggregate of multiple policies with over 5 lakhs. They did a clarification on that, which will come in the Finance Act.
Okay, but from April onwards.
Okay, but only for policies issued on or after 1st April.
Okay, thank you so much.
Sure.
Now, second question. Your name? I'm Ramesh Nakotia, and thank you all for having come over here. And I'll get back to my question. That I have 2 questions. Anubhai, one is, in this bill, there were 2 lakh rupees was specially sanctioned for ladies. Can you elaborate on that? Deposits, and
So those are special deposits which are there. So that's a savings scheme which will come out. Of course, details will come out. It's not on the income tax.
so the taxation on that is not legal. And the second thing,
I don't know whether it will be exempt. I don't think so. But that we'll have to see the fine print. There's nothing in the finance bill.
and one more thing, my children stay abroad, and I want to settle abroad now with them because they have their families over there. So now, as per the new rule, if I buy a house in Canada, for instance, so I'll have to
Pay 20%. So buy it before 31st.
Thank you. Thank you, sir.
Any more questions, please? 2 and 4 questions are over. There is a
RASESH Choksi. Remitting abroad, buying property is one thing. But if you are remitting abroad to maintain a family, that is not part of it.
So that is in fact give a loan to a close relative abroad. You can maintain that. So now if you give a loan to a close relative abroad, you pay tax. Or if you maintain a family member abroad, you pay tax. Because any LRS other than medical, other than education loan, is treated as LRS on which 20% tax is applied. So if you're spending $1 lakh, you pay tax.
Transfer something in order to pay the loan which he or she has taken.
Purpose is not relevant.
LRS.
So again, send it before
Now there is a vacancy only for one more thing. Welcome Mohit Chaturvedi. Just give a big hand to Mohit Bhai. One of the dynamic. Yes, one more. Gracious ladies.
Hello, I'm Advocate Sejusha, practicing indirect and indirect. One question regarding the 87A rebate, the old and the new. Now, as per this 7 lakh limit, so how are you going to?
So 87A is something which is a little bit of a misunderstanding. People say if I have an income of 5 lakhs, I don't pay tax. That's not how it works. If you have income of up to 5 lakhs, because of the rebate, you will not pay tax. So any other person say having an income of 10 lakhs, he or she cannot pay tax. It is only for those marginal taxpayers who have income of 5 lakhs or less will not pay. Now, under the new regime, it has bumped up to 7 lakhs.
Same thing will apply up.
But if you prefer to go back to
Then it's the 5 lakhs, yeah. Okay, that's what the clarity was not there on that.
Of course, we have exhausted the limit, but last one more bonus. ANOOP bhai, if you comment. One more only then. Yeah. Mukesh bhai, you have any questions on diamond trade or something?
Rashesh, as you, ANOOP bhai, sorry. As you explained that rebate of 87A, so we taken that the rebate was there for 12,500 rupees in rupee terms. Even if the tax was higher, we used to get 12,500 as reduction. So now, under the old scheme, would it be 12,500 only?
Nothing changes in the old scheme.
It's just for the news.
Yeah, thank you. Any more questions? So we go to the another most awaited event, Bhavana Ben, who will be speaking to us on indirect taxes. Bhavana Ben? Yeah.
Good evening. It's nice to be back again. Lovely talk. You were so clear, every aspect very well explained. And from a tax which you think of when you have income, we come to a tax which you think of when you want to spend some money. Earlier we were always calling it indirect because it was not so visible. But now, of course, it is still indirect because you don't pay it, you pay it to the vendor, the supplier of service or goods, and he or she makes payment to the government. But that's a tax now which is very visible because of the GST provisions that we have where it is required to be shown separately. So now every time that you are in the market you look, oh, what's the rate that's applied? Is it 5%, is it 18%, is it 12%? So it's very visible now. And we'll be talking about that tax today. But before that, the question which again ANOOP asked, how's the budget? And everybody has a different view. Anybody who says it's not so good, anybody who says it's not so good, overall, don't look at only tax, generally. No, not so good. But the optimist that I am, I would say it's really a budget, as a finance minister started, India at 100. A budget which is for growth. It's so growth oriented if you look at it from a little longer perspective. It's for the India which is new, which is changing. It's digital. And so many countries of the world are now looking at India. Indian prowess in that space is known and it's being respected. It's being considered. We are being counted. So there is a change. And of course we have a youth which is in our favor. And it's so aspirational. Each one wants to do something. Look at the startup space. There are so many people, and I had opportunity of judging Maharashtra government when they do these startup sessions, and they of course give them contracts, or also for some other associations which are funded by Niti Ayog. And what vibrancy, what thought. These young people, some of them just 15, 16 years, and they come up with such fantastic ideas. And when they get support, they convert it into business enterprises. Think of it. It's really changing. And that's where India is now moving to a stage where it is really moving very quickly towards a state of developed nation. And I remember some 10 odd years ago, talking to one of the clients, and they had a very large engineering project in India, and one of their engineers was deputed to India. So he was, on the day when he was leaving, we all met for dinner, and he says, I must tell you something, I must share. So he said, when I was deputed to India, and when I was leaving the country, earlier day, everyone is coming and petting me on my back. Don't worry, it should be okay. It's not going to be that bad. Because the impression all of them had is India is like a village. There are a lot of poor people roaming around everywhere. And there are these cows and buffaloes all over. And that's the country that he's coming to. And on the day when he was leaving, he said, my impression is so different. So different. You are such a vibrant country, full of life. I don't see what I had heard when I came. He said, first time when I got out of the airport, they told me when you're getting out of the airport and you'll see all this around. I said, I didn't see that. So things are different, and he says, when I go back, I'm certainly going to tell people of my country to visit India. And that was 10 years ago. See the change which we have today. No, people who had left India 30 years ago can't even imagine this is the same country. So when you have your friends, maybe from America, from Europe, when they come here and when they are visiting various sites, what they see is complete change. They can't believe. They say you go to this place or that place, you can't believe you are in India. And that's the change which is taking place. Tourism is an area where a big thrust is being given, which will generate a lot of employment. So while yes, there are challenges, and we saw in direct tax that there are some areas which are being plugged by government things, that they are not getting the revenue or they are losing out on revenue which is not their intention. So when we come to indirect taxes, what we find, and generally I would think whether we look at direct or indirect tax, there is stability. The tinkering has come down. So now, and of course the days have also changed. Gone are the days, those who are in manufacturing will remember the excise duty laws, where 12 o'clock in the night, and you would know, 12 o'clock in the night the rate had to change. And people would rush, and you will have the officers sitting in your factory that you don't take out anything at the old rate. Gone are those days. Look at the situation now. Today we don't have tinkering with changes. Broadly, hardly any changes. When you look at customs, very few changes, primarily for rationalization and correcting some imbalances. And now, of course, we don't have much to talk about excise duty. And then we have the goods and services tax. Again, so far as goods and services tax is concerned, it's the council. It's neither central government nor state governments. It's the GST council, where all together have to agree on a provision, whether it's tax rate, whether it's exemption, any change. Even some of the procedures also agreed upon there. So today, what you will see in the budget, which are amendments in the GST law, those changes are also those which have been already discussed and agreed upon. Except that the central government will change, so it will come in the central GST law, and the state will also change, so it will come in the state GST law. If we look at it on an overall perspective, our direct tax revenue and indirect tax revenue, would you know the proportion? Any idea? Of the total tax revenue, what proportion will be direct tax and what proportion will be indirect tax? 97% is indirect taxes. That means when you spend, you pay so much tax, and when you earn, you don't pay. You pay only 3% total government's revenue. Any other thoughts? 60-40. Interesting. At one time, 80% was direct tax, so you are somewhere closer. At one time, 80% was indirect tax and only 20% was direct tax. That was the time when we were not so developed. Right? So therefore, the significant emphasis on indirect tax collection. So where you don't know much and every common man pays tax. Whereas direct tax was for people who earned revenue, who earned income. That ratio has been changing as we are developing, more and more people coming in the tax net. So now we are at 50-50. 50% direct, 50% indirect. So the tax that you pay when you earn is the same tax when you pay on when you spend. That's the ratio, which is indicator of also a growth or the development that we have reached. So with that now, I will hand over to Aarti, who will take you through the specific provisions. There are many provisions, but she'll take you through some of the key ones, and then if you have questions, we are there to answer. Thank you.
Good evening, everyone. So, most of the amendments have been discussed in the 48th GST Council meeting. Their recommendations were out through a press release. Most of them are the amendments relate to those recommendations. But a few, in addition to that, like the one is CSR, which was not there in the council recommendation. So CSR, it was a grey area, there was an ambiguity whether input tax credit of inputs and input services which are used for CSR activities can be claimed. So the CSR activities, there was an ambiguity was whether is CSR related to my business. Section 16 says anything related to business in the course and furtherance of business you can claim the credit. So the first question was, is it in the course of business? There were rulings under service tax, there are favorable rulings. In the GST there have been ARs both in favor and against. But now with the amendment, the government has clarified that you won't get credit, input tax credit of inputs and input services used in CSR activity.
So those who so those who are not very familiar with this input tax credit, it's a mechanism where the taxes that you have paid on purchase of goods or services which you used for your social responsibility. So say you are constructing or you are running a school and you pay for the expenses on which you have paid GST, which is your input tax now. Output side you don't get anything because it's part of your social responsibility. You may not be charging fees or you may be charging nominal fees. But the question was that can you get input tax credit for hospitals? They have significant people run that, right, as educational activity or as medical facility and so on. So there was an issue under Income Tax Act also. There was a question whether you can claim it as deduction. And people said, ultimately it's my business. Why should I not get a deduction? But the amendment had come that no, you will not get. But in GST there was no amendment. And that's why there was a big dilemma. Some people claimed, some didn't claim, some conservative, some aggressive. And finally now we have an amendment in the law which categorically states that you will not claim input.
The amendment presently is not retrospective. So till the period the bill becomes act, can you claim input tax credit on CSR is again a question. It is prior to say 1st April 23, so till financial year 22-23, can you claim ITC on CSR is again a grey area. The second was on, now this is benefit given for composition levy. So sellers, small sellers, composition the limit is 1.5 crores for good suppliers of good. In case if you are supplying your goods through e-commerce operators, you are not eligible to offer composition levy. So that restriction has been withdrawn. You can, even if you are supplying through e-commerce operator, you can opt for composition levy. This is only but for supplier of goods. Supplier of services, if they are supplying services through e-commerce operator, they still cannot opt for composition levy. The amendment in section 16 of GST Act, that is a very clarificatory amendment. Because section 16.2 it said if you have not paid your supplier within 180 days, you have to reverse. It didn't say reverse your ITC. The ITC was not eligible. So it said that you had to add the ITC to your outward tax liability. But practically what we were doing in our GSTR 3B return was reversing it and paying tax. So to remove that ambiguity, this correction is not going to impact practically how we are doing it. In 3B we will continue to reverse it in table 4 and disclose whenever we reclaim it, disclose it again in table 4. The language which was where the act was saying you to add to your output tax liability has been corrected and now they say that you have to pay. So this is a clarificatory amendment. 17.5 we have already discussed CSR. 17.3 value of exempt. 17.3 is apportionment of ITC. So when you are using inputs or input goods for purposes of both taxable and exempt supply, the input tax credit that relates to inputs that have been disallowed. You cannot claim ITC that has been used for exempt supply. Now, what was the value of exempt supply? We have Schedule 3 under the GST Act, which lists down activities which are neither supply of goods nor supply of services. So they are a no supply. They are neither goods nor services, and therefore they said when you are computing the value of exempt supply, you will not include the activities which are listed in Schedule 3. So, say for example, Schedule 3. Sale of, okay, now except there was sale of warehouse goods before custom clearance is one of the item in Schedule 3. It is a no supply, so if you are selling goods, warehouse goods before custom clearance, you don't pay GST on that. But for procurements that you have used, you must have paid GST on the inputs. You are still eligible to claim the credit because they are not treated as exempt supply, you did not disallow them. Now, there was only one exception earlier, that was with respect to land and building. Land and building was to be treated as an exempt supply. Now they have added even sale of warehouse goods before custom clearance. So one of the items from Schedule 3 they have added, and now this is to be treated as exempt supply when you are computing your ITC disallowance.
So those again who are in business will understand that you have something as exempt. Audible. Yeah. So you have something as exempt supply, that is supply on which you don't pay tax, and you have taxable supply. So when you claim input tax credit, that means the tax that you have paid on your purchase side, whether for goods or for services, you can't claim full because part of it has gone into exempt goods which you have manufactured or exempt services that you have provided. And since government will not see, GST is essentially a pass-through. It's a pass-through mechanism. So what you purchase, you get by way of credit, input tax credit, which you can deduct from the tax that you have to pay on output tax. So here, if you don't pay output tax, if you have exemption, you can't get that input tax credit. And there were some anomalies, particularly in relation to the warehouse goods. That means the goods before clearance from customs. So those goods which are in that customs bonded warehouses, there was controversy which is now sought to be removed, cleared. And this amendment applies with retrospective effect. Broadly this time, if you would have seen, hardly any provisions which are retrospective or retroactive. Hardly. Except few, because government is very clear, we want to provide stability, which is what every investor is asking for. This is retrospective because these challenges had arisen right from 2017 when GST was introduced. Government was told this is a problem, but somehow they were not convinced that this needs to be addressed. Finally, they have addressed. So what they are saying is, we will not grant you any refund. This is the position. We accept. But if you have paid, those who have not paid will get away, no problem. But those who have paid will not be able to claim refund. That's the way the provision is.
Go ahead. Section 23. This is a welcome amendment. It is a retrospective amendment, but this is clarificatory in nature. Earlier, so section 23 presently does not have a non-obstant clause. It is section 23 deals with it gives exemption from registration. So persons not liable for registration. Now it did not have a non-obstant clause. So the question was whether section 24 overrides section 23. 24 gives mandatory registration. The persons who are liable to register, 23 is persons who are not liable to register. So now they have got a non-obstant clause in section 23. It says notwithstanding anything in section 22(1) which gives basic threshold for registration, and section 24 which gives mandatory registration. So it is notwithstanding 22(1) and section 24, you are not liable to register under 23. So now the condition under 23 basic is if you are engaged into wholly exempt supplies, if you are not making any taxable supplies. Now section 24 it will say, for example, as if you have a RCM liability, you need to register. If you have interstate supply, you need to register. If you have TCS liability, you need to register. Now section 23 will override section 24. So if you are into completely wholly into excess supplies, even though you have RCN liability, you need not register as per section 23. It's a concept. Now filing of belated returns under GST, we do have late fee, but there was no time limit till date. Even we could file even today 2017 returns, but now they have given a time limit to furnishing of belated returns. So it is 3 years from the due date of the original due date of filing the return. It is for GST 1, 3B, 9 and 9C. So it is GST 1 return of outward supply, 3B is our monthly return payment of tax, GST 9 and 9C annual return, and statement of TDS deduction, GST 7. There is a time limit. Beyond 3 years from due date, you cannot file the return. Government has been given to extend the power to extend the time limit for specific categories based on recommendations of the council. Interest on refund, the change in the language is very limited, but what we see is presently it said that interest will be calculated from post 60 days. So once you file an application for refund, and if your refund is granted after 60 days from the date you are making an application, you are entitled to interest. So the language was, it is post 60 days from date of application till the time you get the refund, you get interest on refund at rate of 6%. They have changed it to the period of delay beyond 60 days. Period of delay beyond 60 days from filing of the application, and then they say government have powers to prescribe conditions, restrictions and manner of ascertaining the period of delay. So whether that period of delay now, we don't know how this will be interpreted, but now it is power to the government to determine what has been the period of delay beyond 60 days. You might not get a straight interest from 61st day till the date of refund. Penalties and now again this is a welcome provision where they have decriminalized of certain offences under GST. Firstly, for prosecution, the minimum threshold presently was tax evasion of INR 1 crore. That's the minimum threshold. If it is 1 crore or more, there may be prosecution against you. That threshold has been increased from 1 crore to 2 crores.
You might be reading in the newspapers, no? And sometimes we wonder that even for 1 crore, people are being prosecuted. So that was the provision.
The only exception is fake invoices. So if you issue fake invoices without any supplier, still the limit continues to be 1 crore.
But that's a big menace, big menace, which the departmental officers are finding, and sometimes they tell us. Once one officer was telling us that why do you have such provisions? You know, these are so harsh. So I said, you won't believe. You sit here in our place and see what happens at the ground. And just 2 days back, before I said they got this information. They went to that place from where the invoices were being issued, crores of rupees. And what was it? It was a half room in some chowk. This is what is happening.
I'll tell you, we have come across one case, probably you will know. There is one person at Chennai Road, near that Hindu college. A person staying in room maybe less than that. Can you believe that bogus invoices, how much he must have given with GST has found out? So more than 27,000 crores.
Yeah, correct. But then, you know, this has to stop. And this is not unique to India. It's all over. All over. In fact, even in Europe, they find situations, several situations. So they have a special various data that they take out and they do the analysis as to where is the leakage. Only thing is they are more focused, but But now with our data that we have, we are also equally focused.
Last point, please.
Okay. Even the compounding range, so where you can compound your offense, has been reduced. Earlier it was 50 to 150% of the fee, the compounding fee that you had to pay. Now it has been reduced. The minimum limit is 25% and maximum is restricted to 100%. And the last one we'll just see where there has been change in the definition of OIDER. OIDER services and
Online database. I don't know, anybody may not be interested. Online database, so I guess you can.
Now I have received a message from Biren that sir has to leave by 7:30. But I am not sure if it's 7:30 PM or AM. Because everybody has eagerly waiting. Sir, dinner can be, we will join. Don't worry. Biren, I must thank you for bringing the great personality for the first time to the Garware Club. So we'll request RASESH bhai straight to address. Indirect taxes, any questions we'll take up later on. RASESH bhai, big hand to you.
No, it was actually, I wish I had, a little bit more time. I think it was very exciting to hear ANOOP and BHAWANA and, hearing the details, and I think there is a lot of clarity. So even I learned a lot. At least I learned a lot more than reading newspapers and seeing TV channels of the impact, the actual nitty-gritty and the fine-grained impact of this. I think we've already spoken about what is good about the budget, what are some parts which are not so good. But I think fundamentally I have seen in the last few years that this annual union budget is more a statement of intention, it's a direction of policy. Because I at least for one do believe, though it is not good for the newspapers and media and the excitement that happens every year, I do feel that the annual budget is in itself a very destabilizing activity. Because every year you are changing, and as you said, maybe the tinkering has come down, but ideally there are a lot of countries who follow, maybe India should also look at that. When the government comes in, they present a 5-year aggregate budget, and the annual is only an update and a statement of accounts. Because whatever changes they want to make, they can actually easily make that outside of the budget. If you want to increase, you want to charge LRS, you want to charge some extra tax, you can do it outside of the budget. But we are also used to this annual budget where there is a lot of excitement and media and analysis and all. I think fortunately this government has reduced that. But what I find very interesting in the budget is the statement of intention. What are the broad things we are seeing, the trends, like what ANOOP said. I think there is clearly a move towards not letting HNIs earn this extra return that has been there through REITs and InvITs and MLDs and all that. Part of it was maybe arbitrage, part of it was also you are trying to promote InvITs and REITs, so you have those concessions out there. I do believe that eventually as India evolves, the arbitrage will start coming down, and ideally you want to be in a country where all instruments for savings should have the same income tax treatment. Why should a bank deposit not be the same as an NCD or an MLD or all? So I think we are going towards that. This government has made good effort. So I'll just give that overarching remark. I think what I found very good in this particular budget is there is a Hippocratic oath which says first do no harm. So you want to make sure that you don't do any harm, and I think on that count this was a good budget. There is not a lot of harm, so there are some things for HNIs and all which could be harmful, but overall I think it's a very balanced, very stable budget. I think there is a clear emphasis on investments. The investments of the last 8-10 years, because of all the NPAs and bank loans and uncertainty and all, in India we have seen that the private sector investments have been coming down. So the government has been the one that has been making the investment. That continues for this year. Though I think the amount of increase that they have shown, I am slightly skeptical because I don't think the government has the capacity to actually execute at this level. To invest the kind of what they want to invest in roads and railways and all. So the allocation is made, the intention. The other good thing they have done is the subsidy allocation for food and all have all come down. But what has come down increasingly is more out of efficiency and the leakages have been plugged, which I'm sure all of us in the room will agree that ultimately the leakages should go down while the people who need to get the advantage of that, it should reach them. So for the last 5-6 years, thanks to things like direct benefit transfer and Aadhaar and all of that, the leakages have come down. So they've reduced the allocation for that, which is also good news overall for us. So I think overall, the third thing I'm fairly positive about is the intention to bring the fiscal deficit down. Now, I used to be also the one saying, how does it really matter whether it's 5.8 or 5.9 or 6.1 or 6.2? It's all nitty-gritty. But what happens that is ultimately that is the amount of savings in India that the government is using it up. So that much is not remaining for all of us. And that even the 0.1%, our current GDP is close to 3.8 trillion US dollars. So, I mean, now the numbers have become so big that we have to stop counting in rupees lakh crores anymore. We have to go to rupees billion and trillion now, and you will start seeing it. I think India will also will stop using crores and lakhs in the next 3-4 years, because now India is becoming size. As a size, we are becoming very big. I mean, I'll speak about it afterwards, but we are now at, by the end of this year, we will be 3.8 trillion US dollar economic size. There are only 4 countries ahead of us after this. Of course, USA is the biggest at about 22 trillion. After that comes China at about 14-15 trillion. Then comes Japan at 5, then Germany at 4, and then India at 3.8. So we have already passed Italy, Canada, UK, all of them. By the end of, in the next 1 year, we will overtake Germany also, and we will overtake Japan by 2025. And then India will be amongst the 3 biggest countries in the world. So that's the size of India. For other, I think we have quite a few people who are in the US and we understand US. I think all the, all the HNIs in Mumbai, they always have, either relatives or brothers, sisters in the US. So we understand US well. The way to think about it is, at 3.8 trillion, India is what USA was as an economy in 1986. So US economy size of the 86 one, that is, they have gone to 22, but they were also 3.8 trillion in 1986, which is what we are now. So we are about 40 years, about 38, 29 years behind USA in size. Of course, India has a slightly bigger population, per capita, all those issues are there. But we are now getting real scale as an economy. But I'll speak about that. So I think at that size of 3.8 trillion, even a 0.1% extra borrowing from the government is a fairly large amount. So I think the intention to keep the fiscal deficit at 5.9 is very good. I think there is risk to that because this is hinging upon a GDP growth of 6.5%. I do think given the global recession which is looming, there will be a recession this year globally. It seems almost inevitable. The only question is people asking is whether it is going to be a deep recession or a quick recession. But recession is inevitable. That will affect India's growth also. So I think a lot of economists believe that our growth will be closer to 6.1, 6.2, not 6.5. As a result of that, government's income and everything else will be lower. I think there will be slippage on that 5.9%. So I think on government's ability to invest, there could be slippage. On government's ability to maintain 5.8 could be slippage. But the intention to invest, the intention to invest in roads and railways and all is actually very good. Government continues that. It's a very stable budget. I think they have also not made it very populist with a very clear intention, because the budget in 2024 will be just with elections around the corner. So I think if they have to give away anything, they'll keep it for that. So it's actually better. They're very smart in that sense that they've kept it low now. So anything they have to give away from the election point of view, they will keep it for 1 year. And you should expect that in the 2024 union budget, you might see some more things for the rural areas and poor people which is okay. I think India is now becoming so large that 20,000 crore, 30,000 crore for government to spend as a result of elections and all will not really impact it in a big way. So that's, I think, broadly, how the trend in the budget. I'm sure there'll be questions on that. I think the other thing people ask is about impact on the stock market, which I've always maintained. I mean, I've spent almost 35 years now, and I must say that the stock market has its own cadence. It has its own nuance. It has its own. It's not always the economy and the budget is one of the factors of what impacts the stock market, but not the only factor. There are many factors, from global liquidity to FII to short-term trends to confidence, optimism. Everything goes into what happens in the stock market. And here, if I may give you an example, and this is what I learned. I graduated in '89. I joined ICICI. I used to work in ICICI, and the index, the Bombay Stock Exchange, there was no NSE at that time. The index was about 800, which is what, about 40,000. How much is it up to the minute? Okay, 59, 60. I've stopped following the Sensex. I follow the Nifty more. So it's about, say, 60,000. It was 800 at that time, in '89. From '89 to 1994 was, I think, one of the most chaotic phase of India. If you remember '89, we had the Bofors scandal, then the VP Singh government, and we had the reservations for OBC in the, as part of the Mandal Commission. Then in 1990, we had the Chandrasekhar government, which was short-lasted. In 1991, we had the assassination of, Rajiv Gandhi assassination. We had the Gulf War, oil price went up. India had a balance of payment crisis in 1991. Then in '92, we had the Babri Masjid, and then we had the Bombay bomb blast and the riots in Bombay in '93. We had the Harsha Mehta case in between, if you remember that. We had Harsha Mehta, Babri Masjid, then the Bombay bomb blast, then the riots. Then we had Harsha Mehta accusing the Prime Minister of paying 1 crore in the suitcase. All this happened in those compressed period of 5 years. Can you guess what happened to the stock market in those 5 years? The 800 index in '89. How much was it in 1994? It had gone to 4,400. And all this drama was going on. India balance of payment crisis, Harsha Mehta crisis, huge amount of up and down. But if you see the index, 800 became 4,400 in those years. So I always give an example of this. This is what I learned very early on in my career, that the stock market has a cadence of its own. It has a lot of drama and the volatility and all. But after 34 years, the one thing has been very constant is the stock market goes up. The one factor that has the highest impact on how much the stock market as a whole goes up. Not individual companies. They have their own, stories and drama that goes on, as we keep on seeing all the time. But the market as a whole, it grows at almost the same rate as the corporate earnings growth. Over 30 years, the growth in the market is equal to the growth in the corporate earnings. And if you think about it, the stock exchange is depending on the price earnings ratio, PE. If the E is growing at 14% a year, then the P will also grow at 14% a year for the same PE. Now the PE goes up and down, drama happens, but over 30 years, if you say the market का PE 18 होना चाहिए, 15 होना चाहिए, जो भी है, if it is going to be 18, then your whatever P is growing, the P will grow by that. So if you go back and track the corporate earnings over 30 years, and you see the stock market return over 30 years, they are almost the same. So as we look at all that, so I always explain this only in this, 2 points. One is stock market has its own cadence, has its own drama, has its own excitement, and actually that is what is exciting. Market falls 1%, headline will come, investors will lose 3 lakh crore of wealth in one day. And I've seen that between 1 to 2% any stock and all is normal noise in the market. That's noise. That's not anything really changed in trend that has been there. So if you understand that, if you understand market has its own cadence, and you understand that the market will grow with the stock market, you will stop trying to figure out how the annual budget impacts the stock market. In the short term it impacts because it affects emotions and the investor psychology, and there will be capital gains and that will help. But we have lived through changes in capital gains, changes in dividend was taxed, became free, then again got taxed. There was no STT, then STT was imposed, then STT was imposed in one particular way, then STT was imposed in another way. All that changes have happened in the last 30 years. The market has kept on growing, the indexes kept on growing, corporate earnings have kept on growing, the market volumes have increased, the investors in the market have grown. So that's a trend that will continue, because India is now getting to a stage where we have a financial system that was only dependent on banking. Now we are banking and capital markets. Because ultimately any financial system has only one aim: how to channelize savings into investments. If I am able to save money and you are able to use that money either for as an entrepreneur or you are able to invest it to buy a house, the financial system has to channelize money from me to you. How they do it efficiently is the most important. Earlier we had only banks, now we have banks and capital market, whether in REIT, mutual fund, insurance, via bond market, it's all ultimately that only. So I think that's my very basic understanding of stock market, why it operates. In the short term, there will be a lot of drama, there will be a lot of ups and downs and they are real. Because the market is, what does the stock market do? The stock market is constantly trying to discount the long-term future of a company or the market in the short term. And that information is coming on a minute-by-minute basis. It is basically an instrument which is constantly adjusting for the future. Constantly. So the other example is the house out here, and if there is construction work going on, the house price will go down. When the construction work gets over, the house price goes down. When there is another building coming up in the vicinity, house price will go down. When there is another building, that is having problems and leakages and all, value of your house will go up. So that is what happens if you see your house price on a minute-by-minute basis. But fundamentally, we don't have that. We have the stock market. So that is what the stock market does. I always say that look at the long term in India or any stock. If you have the time, understand the stock, analyze the company, invest it on that basis. If you don't have the time, then invest in index as a whole. I do think that the Indian corporate earnings will grow at 13-14% a year. So if you invest for 3, 5, 8, 10 years, you will get 13, 14, 15% if you invest in the index, which is the easiest thing if you are busy with your own work and all that. But the stock market also gives you excitement, intellectual stimulation, all of that. Actually, if you want it for that, then understand that is what you are also trying to get out of that. The last, I think, 2 things I want to say is, I think one is I briefly spoke about India. I think the next 8-10 years in India are going to be fairly big because our economic size is becoming, I would say, unprecedented. I don't think any of us have seen the scale that we are seeing in India now. And I remember in 2007, if I ask this audience, how much do you think was the size of the Indian economy, of the GDP in 2007, which was also about 60 years after independence? Any guess? No. Okay, what is the GDP size of the economy? We had touched $1 trillion, which means after 60 years of independence, Indian economy size became $1 trillion. We added another $1 trillion between 2007 to 2015. We became $3 trillion in 2020. We are now 3.8 trillion in 2023. Now we are adding $1 trillion. We will add $1 trillion to our economy in the next 18 months. Which means India का जो size था of whole of India in 2007, not very far away, is getting added in 18 months. And after 2028, India will be adding $1 trillion every year, which is the size of India in 2007. So this is what we call the golden age of compounding for India. And it is true with companies, it is true with individuals, that now we have got size, we have got scale, we got a growth rate which is still fairly attractive compared to globally, and we have another 15-20 years to go. Bhawana spoke about the young population and entrepreneurship and all that. So India's growth runway is there for the next at least another 15-20 years. Just because urbanization, young population, investment, consumption, converting savings to investment, the needs are so much that the next another 15-20 years will not start hitting any growth hurdles. So given that, because as we always say, that if you want to compound your wealth, if you start with 100 rupees and even if you compound it at 80% a year, it won't be much. But if you start at 100 crore and you compound it even 14% a year, it's much. India has got to that stage. The starting point is 3.8 trillion. We are going to compound starting from this for the next 15-20 years. And for 15-20 years, maintaining a GDP growth of around 6 to 7% should be available to India. And the reason it will be available is our savings rate is still very high. We are still saving about 30% of our GDP. The other way of looking at it is at $3.8 trillion, 30% of 3.8 trillion is about $1.3 trillion. Foreigners invest in India annually about $18-20 billion, maybe $20-30 billion. Last 2 years they've been removing money from Indian stock market. But over the last 25 years, the total money foreigners have invested in India is only $500 billion. We are saving $1.3 trillion every year now as our own savings. And that's why you see in the last couple of years where foreigners have sold almost 3 lakh crores from the Indian stock market. The stock market is still very stable because India has now become truly what I call Atmanirbhar in our own capital needs. And it's another story of India. And I think here I must caution you, as Bhawana also said, there's so much exciting going on in India. I think all of us are fairly bullish on India. But India is a glass half full and half empty at one time. In fact, one of the quotes I like is that India works in India, an optimist and a pessimist. They are both happy and they are right. They're both happy and they are right. So it's up to you how you see the glass as half full or half empty. There are a lot of problems in India, and maybe I think I'll speak a little bit on that. But at this stage at which we are, I think India's size, our local savings all have become of a scale that is unprecedented. Our current savings are more than what the GDP was in 2008-9. That is the scale of the savings in India, which we are investing. If you invest it smartly, it results in more growth. It's like any household. If you save money and you invest it smartly, it will result in growth. So I think getting a 6 to 7% growth for the next 15-20 years is going to be possible. If India grows at between 6 to 7, corporate earnings of 13-14 should be possible. If that is possible, stock market returns of 13-14% are also available to us. I think there are 3-4 other good things happening in India. As I said, I think one is this entire the large, investable surplus we have, the saving pool. Earlier we were inefficient in saving that via the banking system and all. Now with capital markets, efficiency is higher, and that is why more and more people are coming towards capital markets. So I think that is the one part. The other very interesting thing that has happened in the last 5, 6, 8 years in India is our physical infrastructure is falling in place. I must remind you, in 1948, to travel from Flora Fountain to Wali Seaface used to take you about 45 minutes. Today also it takes you 45 minutes. Okay? It's the same time. I think after 20 years it will still take you 45 minutes. Maybe there will be a coastal road and all, but the traffic will go up. So, like airport has always been an hour away. So even if the new airport comes, it will be an hour. So we should assume that. So I think the more things will change, the more there is going to be growth on one side and there will be other hurdles on the other side. So India is now at a stage where our physical infrastructure is growing. And as you have seen, I think even what is happening around us in Mumbai is also very transformational. But along with that, the entire digital infrastructure of India, we are world class already. World class already. If you look at UPI, Aadhaar, GSTN, all these there are countries in the world which have not been able to do UPI. Even the more advanced countries have not got UPI done. Aadhaar, almost 1.1 million people having done Aadhaar. Our electronic voting system is actually one of the best in the world, even as compared to US and all that. So we have now learned how to use a technology at scale. And I think Aadhaar was a great example of that. Just to have done Aadhaar, even COVID sheet and all, the COVID certificates and all that, Arogya Setu, FASTag, which was only for toll, is now available for malls and parking, airport parking and all. Very soon, our insurance company is working. You will be able to pay car insurance through FASTag. You will be able to pay your car, the vehicle tax via FASTag. So FASTag will become everything related to your car, almost like a mini DG wallet for your car. For FASTag. FASTag is growing. There is obviously things like OCLD and Headstack and there is Bhashini, and so there is a whole digital ecosystem. The annual information statement for direct tax, GSTN, and when you connect all the dots, there is a phenomenal infrastructure getting built for us, and it is going to help business, is going to help grow. And I think in this we are world class, because the scale at which we are able to do this is amazing. And the third, I think, very big thing happening in India is entrepreneurship is now becoming all India. Earlier it was restricted to Mumbai, Delhi, Bangalore, Calcutta. Now you go to any small town, people are becoming entrepreneurs. And we are seeing more and more companies, more and more entrepreneurship. The spirit of entrepreneurship is really gone down. To compare it, and since we are at Garware close to MCA, it happened in cricket in the 80s. Until 80s, all the cricketers came from Mumbai, Delhi, all the cricketers from there. After 80s started coming, Kapil Dev was the first one who came from a smaller town, and then we had MS Dhoni, and now you see more and more cricketers who are coming from smaller towns of India. And the same thing is happening in entrepreneurship. We will see more and more companies which are getting created, large companies which are outside of Delhi. And that is also great for India, because that gives a huge amount of opportunity. And the last thing, with all this optimism, I must also say we have to be careful in India. Because India is one country which is great when you see it on a long-term basis. But when you see it on a short-term basis, it's chaotic. Okay, and I always say that in India you need a bifocal vision. One eye has to be on the long term, but another eye has to be on the short term. And the short term is real, it's not hypothetical. It's not imaginary. There are short term, whether the Hashemata scandal or Ketan Parekh scandal or the Indo-Pak war or the Bombay bomb blast or the parliament attack, whether it's geopolitics, whether it's politics, whether it's economic, all these scandals, whatever happens, they are real. They have huge impact on short term. Whether it's the 3G scandal or 2G scandal or the coal scandal, all of that, those things are very, very impactful. They impact business, they impact individuals, people go bankrupt, all that happens. So India is a country which is going from year to year, which has already gone from year to year. But as we Indians, we don't take the straight line. When we drive our car in the road, we don't go into one lane, right? We want to go to this lane, this lane, this lane, this lane. So India is a very chaotic, short-term chaos, short-term drama. All that is very real. We see it on a week-by-week basis. So I always say, like Edelweiss, when we became 25 years old, I should say we are 25 years old and 100 quarters old. The 25 years have been great, but 100 quarters have been great. Every quarter some drama, some STT tax will be levied, some MND changes will happen, you have to change your products, you have to innovate, you have to constantly keep up with that. So India will always be short-term drama, long-term growth. Anybody who is spent 20-30 years in India, whether it's Hindustan Unilever or HSBC or Citibank or any Indian company, Asian Paints and PD Lights and all that, 30-40 years के बाद all the good times come. So you have to have really long-term patience in India. You have to last on for a long time. You have to manage the short-term the hurdles that they happen, and they are real hurdles. You can't close your eyes and say, I will go through, 30 years automatically. Each time you have to go through that, you will have to understand the impact, adjust yourself, adjust your business model, constantly you have to adapt, you have to be agile. So India needs you to be agile all the time. I think we have a lot more drama and complexity than we need as a country. It will be easier to go like this, maybe with a little bit of drama, but a normal country will go from year to year with some drama. India will go with a lot of drama. So we should be prepared for that drama in India also. But on a long-term basis, I don't think there is anything that will impact our growth. We have gone through balance of payment crises, we have gone through a lot of other things, Hashemata, stock market crashes, all of that. Our stock market has not been closed for last, I think, about 23-24 years, even for 1 year, which is unique in the world. Even the US was closed after the attacks. India was never been closed. The stock markets have not closed on any day. We have not banned anything. We have not banned. So we are very, very evolved as a country. But our digital infrastructure is very evolved. Our physical infrastructure is not as evolved. Our other systems and processes are still not as evolved, and that's why we have all the chaos that goes. So I think along with that, I wanted to just make a few points. Thank you very much. It's a great honor to be here.
What a brilliant talk. I think we have questions of 5 questions.
Yeah.
And each question costs 1 crore. 1 crore.
No question, just one word.
Yes.
Adani. Just one word.
So initially I was very happy when I was introduced to ANOOP. No, earlier in the day when I was introduced to ANOOP, I was also told that he is a board member of one of the Adani group companies. So I'm very happy that he can some maybe inside color, but maybe he can be conflicted. I think insurance, because I think Adani Group is also has got 8 or 9 companies. There are companies which are evolved and companies which are emerging out there. The only comment I would make is, having seen this for many years, any group when your total borrowing starts reaching about 2.5 lakh crores. At that time, the ringing of the bell goes off. That if you remember in 2018, there was a Credit Suisse report that came out that Reliance was overdue. At that time, Reliance was also about 2.5 lakh crores or so in that vicinity. Then they immediately raised a lot of equity and reduced their, borrowing. They almost raised 80,000, 90,000, 100,000 crores of equity after that. $14-15 billion of equity. Even SR Group reached about 2 lakh crores when their problems started and they sold SR Oil and if you remember and I think all the groups are very strong, but when you are one group and you start reaching that scale, given India's size and given the exposure and all, at that point there is a feedback from the market that you should reduce debt now and raise more equity. And that is happened to everybody. That is what happened to Adani. Adani also, I think, the current debt is about 2.5 lakh crores. And now, I think what is stated also is about 2.5 lakh crores. Maybe give or take a little bit. But I think everybody who has reached that stage, Birla, Tata, has then gone out and raised equity to reduce debt. Has also, I think, reallocated capital. Maybe scale back growth a little bit, because this is the way the market works. The market is saying, "Abhi thoda kam karo debt by raising equity." I think that is why the FPO is happening, also to reduce the overall borrowing for a loan. And now, over a year, 18 months, I am sure all these are smart business people and they will take actions. They will recalibrate how the capital is allocation, some assets. They have some very good assets. The port and the power and even Adani, Wilmar and all these are very good companies. They also have some early stage investment in Adani Green and all of that, which are still getting invested in. But I think overall they have some very good assets. The group has shown very good execution capability. And they have high promoter holding. I think the biggest advantage is the promoter holding is very high. So they can always reduce their holding by selling equity. And now the equity is also become attractive for the new investors to come in. So I do believe that they will raise equity, how they raise, which company they raise will be up to them. I'm not involved in that. But having seen the group, I think they are a strong group. But anybody who reaches this, what I call the magic figure of 2.5 lakh crores, starts getting some pushback from the market.
Thank you. Any other than Adani? Any questions? Your name, please. And what?
Rashesh bhai, thank you so much. Anup bhai, all the stalwarts are sitting here, a lot of senior members are sitting here. My name is Vijay Jain, Chartered Accountant. Rashesh bhai, especially to you, since you are from market, and otherwise I do respect the company. So there is something called double trading which is going on in India since 80s. Recently, there was an article on money control on 2nd of Jan, which I tweeted to SEBI, PMO, Garware, and everyone. No reply was received. But sir, what is the action you guys are taking? Because there is a huge loss to the country in terms of taxes. The article is very clear, very clear, very detailed article. So just want to understand, because you belong to the industries, because there is a loss to you also. In another way, right? So what is SEBI doing? What is PMO, sir? Question. What is SEBI doing? What is PMO doing? What is the finance ministry doing? I think a lot of money is going there. Direct tax, indirect tax. So what are they doing? If you are aware of that, insiders.
I have no idea what SEBI, PMO. I don't think the PMO is really very intensely, trying to solve this problem. Because I think they have bigger things to solve. I think it is an issue, but over the years, I think the way our capital markets have developed, the percentage of the unauthorized trading versus authorized trading is become too small in related.
So the article says it is equivalent of maybe more than official.
No, it can't be equivalent.
Share the article with you.
No, the articles, we should also remember the articles tells anything which are there. Again, but over the years, I don't think it is there. But anyway.
Thank you. Next question.
The markets in 60 years. What is your expectation after 5 years or 10 years? Sensex.
As I said, 40% compounded, everything will go up and down. But at about 15% every 5 years, it should double from here. After 5 years.
Yeah, any more questions?
Good evening, everybody. It was really an awesome time here. Gained a lot of knowledge. My question is regarding residential properties. So last year there was a decline in the stamp duty. So are we expecting something like that in the near future?
Should we, is it on the wish list? Yes. Would it be on the wish list of the government? I don't think so. And why would they do it when by 31st March anyway there's a incentive to buy now that it is coming. So I don't think that's going to happen.
Something on the promissory notes. I heard that now through the gift city, these promissory notes, participatory notes, sorry, have now been officially been done, and now investors will be able tax-free status to that. Do you think the investments will increase?
I think it is the intention. It is the intention. Basically, if the city should do all what is being done offshore, whether it's the P notes or the the forex, what is called the NDR market, all of that should come to Gift City. I think it will take 4 or 5 years, but every year it's growing. And the idea is to create a Gift City and like an offshore market with India, which at least is closer to India, will create jobs and all of that. So what is happening in Singapore and Dubai should ultimately come here. It will take, I think, a few years. You need the legal system and all. But almost every asset manager, every broker is now opening an office in Gift City. And the activity is going on every year. It will still take 4 or 5 years for the legal system and everything to start following. But I think all these things take 8-10 years to evolve. And I think it's overall a good thing. It will come. I'm actually fairly confident. All offshore activity will come.
My name is Amrit Purwal, Chartered Accountant from Jain Chartered Accountant Federation. My question is to Bhavana about GST. All these input credit issues, lot of issues, lot of pains to all the dealers as well as government professionals, everybody. So, what it is feasible to introduce reverse charge mechanism on all the purchases? This, whatever you purchase, why you have to pay GST to the supplier? You pay it yourself. You deduct the GST, pay it yourself to the government, you get credit, whatever you paid in cash. So those sort of mechanism, can it be evolved? Yeah.
One would have to really think through it for government to decide. But reverse charge mechanism in our country is comparatively more than in other countries. Yeah, because some of the people initially, like truck owners and all, said we just can't comply. So let it be reverse charge. And in that we have the lawyers. Mechanism is very difficult. One would have to see.
Thank you. We must thank Rajbhai Jiraupata, our governing director in our club. Thank you for coming. Thank you, Rajbhai. Yes, sir. One question. To whom?
Regarding that annual taxation, at
Long term is 20%. Short term is full slab rate. Whatever you are applicable slab rate.
Taxation on these was 10%.
Sir, you listen to the learned
So
counsel.
earlier it was 10%. Now it would be as per slab rate. So it could be 10, it could be 20, it could be 30, it could be 35, it could be 39, it could be 40.
Even if it is more than 3 years.
Even if it will, normally that I don't know whether MIDs will be more than 3 years, because normally they are 18 to 22.
Biggest issue of having is in the next year.
So, but even then it will always be short.
So it will be taxed at your
Personal level.
Rashesh bhai, there is a one small chip which has come in my pocket, that what are the shares in which we should invest now? See, these I think are 10
He's expert, I think.
specific, you want to say something? Acha, our member would like to say something. But don't believe in too much.
You invest in infrastructure sector, banking sector. This will be better in that you can go for some IT sectors also, so IT stocks also. So basically, this will be for long term, 4 to 5 years. I think it will be any stocks you can select from that area. Yeah, there was no specific stocks.
Rashesh bhai, I mean, here the cheat says that he should be very specific, not general.
No, sir.
Okay, what he says is after that talk is over, he would like to talk to open the account. Rashesh bhai, anything else you want to say, sir?
I think as you know, I think the prospects of IT sector will, I think over the next 4-5 years they look very good. There is a short-term hiccup because of the US recession and all, so you might see this year some pressure on that. But overall, I think the IT sector is a growth engine that is unstoppable. And it is also fairly global, regulated, the scale is also there. So I think that is what I always think is an easy one for us to do.
I've stopped looking at individual stocks for a long time, as you can see, because the older I've got, the more I've realized that investing is a 3 to 5 year horizon. It may not be as exciting, but it is actually a lot more profitable.
So people are more inclined for equity questions, but my take is that the debt investments would also prosper and it will give you more stability and the safety also. What is your take?
The point that you have made is actually very important, because I think everybody holds debt. Everybody keeps money in the bank and all that. Interest rates keep on going up and down. While equity usually just goes up. So my advice to everybody is, depending on the instrument, whether it's MLD, bank deposit, you should be very agile in switching and doing all that, because 0.5% extra, 1% extra can be fairly additive for the returns. While equity market, you should not be too agile. Equity market, you should be aram se. You know, if you have to buy, hold, keep it. Unfortunately, people do it the other way. They are very patient in their fixed income instruments and they are very agile in their equity investments. Ideally, it should be the other way. But I do think India, the entire, whether it's bond market, InvIT, REIT, MLD, AIFs, this whole new alternative space that is emerging is actually very good, and more and more investors are understanding that this entire space is not more than 8-10 years old. AIF, InvIT, REIT, MLDs, bonds, all of that is only 8-10 years old. But I do think it will promote a lot of efficiency, and investors who are investing, understanding it, will get a lot more opportunities. But in this, I would always say, be agile.
But sir, why then SEBI is keeping big ticket size in such products?
As I said, because this is early days, these products are new, so they want to make sure there is a threshold. Because in our country, if you open the gate, then the retail investors can be abused, they can be missold, all those can happen. While I think because the education of the market, of the investors, the education of the market people is also happening gradually. So I, for one thing, it's a good idea to keep a threshold so that only people who are investing X amount of money, because then they will apply themselves, they will understand, they will ask all the questions and all. So, and it's early days, it's only 8-10 years old when these products have come about.
Sir, a question to others gathering here, and we have a lot of ladies also here. The digital gold investment which is being initiated, how far do you think in the Indian scenario where we all believe in physical gold? Like, आप देखेंगे तो हर एक के पास एक अंगूठी तो रहती है, if not anything else for that matter. Will it really take on and will it be successful? What is your take on that?
So when you speak to investors, people who buy gold. So Indians, I think we use 1,000 tons of gold every year, close to 1,000 tons. The total gold we have in the country is valued at about $1 trillion. Is the gold in the country, total gold we have. But we basically consume tons of gold every year. About 70% of this is used for consumption purposes. When somebody is getting married, getting all the bangles and everything done, especially people in the rural areas. So gold has two things. It's an investment and it's a consumption. So the consumption part is about 70%. That will not become digital gold. Because that is consumption, that you wear it or keep it at home or it's yours. It's a consumption. While the other 30% which you are using for investment will slowly is actually moving to digital gold and gold funds and all of that. But that's only 30% of the market. About 70% of the market. India, about 1.3 crore people get married. Sorry, 1.3 crore marriages happen every year. And in every marriage, X amount of gold is used. So you can just calculate how much gold will be consumed in India. And that happens every year.
Thank you. Any more questions, sir? We have any more questions from when the refreshment starts. But on behalf of everyone, we have our director from Garware Clubhouse, C. Nanesh Sangvi, who will be proposing a vote of thanks.
First of all, thank you very much on behalf of Garware Club and Managing Committee. Very much thanks to RASESH bhai, BHAWANA and ANOOP bhai, wonderful speaker, wonderful knowledge sharing. And I must say that last 2 years, ANOOP bhai and BHAWANA will keep on coming and enriching us in terms of knowledge. But as RASESH bhai talks about number of years and then translate into the number of quarters. So wish list from our side that whatever quarter which he has missed, I hope every quarter now RASESH bhai will come here and guide us about the stock market. That's a wish list. Of course, that guy will help us. And I must thanks to DILIP bhai, Shardul bhai, and specifically Biren bhai, who introduced us to a wonderful speaker. And hope our business comes into the reality. Thank you, RASESH bhai. Thank you, BHAWANA.